We will see when we have the data and the numbers, because we are really data dependent and we try to assess the situation based on figures, on data, on facts. We don't like to, operate on the basis of hearsay, assumption here, prices increases there. What is true, though, is that we have been revising upward many of our projections in the last 3 quarters. So things have picked up faster, and that is true for growth, that is true for inflation, and that is true for employment. So in a way, it's a package of good news, because it means that our economies are responding, jobs are being created again, the service activities, which were completely down for so long, are now, coming back in full swing. So all that is good, but of course it induces frictions and those bottlenecks, or those supply chains that have been disrupted because of the pandemic, and where reinitiating the machine is taking time. But in the main, all of that we hope will last when it comes to growth, so that activity continues. We hope will last when it comes to jobs, so that employment continues and unemployment goes down. And for prices, we think that there will be a return to much more stability in the year to come, because many of the causes of higher prices are temporary. When you look at what's causing it, a lot of it has to do with energy prices. You look back a year ago, prices were rock bottom. They have, of course, moved up, and the difference is explaining a lot of the inflation that, unfortunately, people are experiencing at the moment. The same goes for some VAT impact, where VAT was reduced in order to stimulate activity, particularly in Germany. Now VAT is back, so that's another base effect, if you will, that explains the prices levels that we're seeing now.
But it seems that for the first time in many, many years, the so-called slack in the euro area is actually reducing, meaning that wages are also on the rise because there are not enough people to fill the open positions. Is that something you're monitoring, you're acknowledging as well?
Yeah. We're paying great and close attention to this issue of slack. And there is still quite a lot of slack in terms of employment. We still have at least 1 million more people unemployed today than pre-pandemic. So, there is still a lot of ground to cover for employment to return to the pre-pandemic levels. And we hope it will happen. And as we close that gap, clearly the economic activity will continue to be stimulated, and we will see movement on the inflation front.
Is that also the reason why during the last press conference you didn't want to say that this is tapering what you have decided? Because in a way it is, because you're reducing stimulus. I mean, what is taper?
No, I said the lady is not for tapering.
Exactly.
And the lady is for calibrating, because this has been our policy. Our monetary policy is intended to procure favorable financing conditions. Why is that? Because we want to support the economic players, whether it's households, whether it's enterprises, large corporates, sovereigns. All of them need to have favorable financing conditions to cross that bridge towards the post-pandemic stage. And to make sure that there are favorable financing conditions, we look at the whole chain of financing, and we look at inflation outlook, and we determine how much monetary support is needed, and that helps us calibrate the purchases that we believe are necessary, which is why we calibrated and decided to purchase moderately in the coming quarter.
You said you were planning on purchasing moderately. What does it mean in numbers? Does it mean 60, 70, or is there more flexibility to it?
There is flexibility to the pandemic emergency program. That is one of the landmark of the PEPP, as we call it, pandemic emergency purchase program, because we want to adjust. We want to have the ability to, really operate as close to variations as possible to make sure that financing conditions remain favorable. So it works both ways. If we see that less purchases will still procure those favorable financing conditions, we will purchase less. If we see that more is needed, we will add to the purchases.
The Financial Times did run a story based on a call between German economists and your chief economist that soon after the projection horizon, inflation will hit 2%. And then they had the conclusion from that that a rate hike could be on the cards already by 2023. So why is that wrong in your opinion? Because you have defended that conclusion.
It is not at all our conclusion. And, you know, anybody is free to draw their own conclusions on the basis of hearsay, second-hand information, quick look at this or that. What I know for a fact, because I know my chief economist and my colleague and friend Philip Lane, is that he never would have said something like what was alleged to have been said. Now, of course, he would say, and I would say, that if we continue having a good monetary policy in the future, at some stage, we must hit the 2% mark, because that's our job. That's, you know, price stability is defined under our new strategy review by reference to the 2% inflation mark, which is identified over a period of time, because we are not going to respond, you know, abruptly, or we are not going to trust one number. But of course, we believe that if our monetary policy is successful, we will indeed hit the 2% inflation.